You're listening to the Millennial's Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablakan.
What's going on, everybody? Welcome to another episode of the Millennial's Choice Show. Are we rolling, Carson? We're good? I'm your host, Matthew Ablakan. I'm here with my brother from the same mother. And you know what? Danny Ablakan, welcome to the show, Danny.
Thanks, man.
We never say we're here with Carson. Do you feel not included? Do you think we should be more inclusive, Carson?
Thanks, buddy. Wow, look at that.
There you go. There you go. Welcome to the show.
Carson's a much appreciated member of the team here.
Yeah, very much so. And today we got an awesome episode for you guys. We want to talk about, Danny really wants to take the lead on this one. So tell him, Danny, what do you want to talk about today?
Guys, today we're going to be talking about how first-time home buyers can take advantage of some really, really cool mortgage products. And you know what? Even if you're not a first-time home buyer, you could take advantage of these really, really cool mortgage products. I want to get into it with Matthew, my co-host here. And that way we can go into really good detail about how you can get into the real estate market if you're on the sidelines.
And are we going to touch base on mortgage products available to investors or to people like myself? We have a number of different properties.
Dude, let's do it.
Traditional
all,
lending doesn't cover it, so I have to go to B lenders or other programs. You're going to cover all that?
The world is our oyster today, my friend. We're going to go through it all.
Let's go. All right.
No limits.
Where would you like to start?
Okay, so just to clarify some things. So for those of you guys that don't know this, there's different kinds of banks, okay? There's what we call A banks, which is like a TD Bank, Scotiabank, one of the big five. And then as well as credit unions, things like that, that help people.
So there's different types of lenders.
Lenders, yeah, exactly. Yeah. Lenders. That includes banks, credit unions, things like that. And a lot of them are categorized into like the A pool, like I just described. And then there's ones in what's called the B pool or B banks or B lenders. And a lot of people oftentimes confuse these guys for the private lenders, which we'll talk about a little bit after. But these guys are not private lenders. They're fully regulated. Some of them are banks, and they offer really, really good programs for people that are first-time home buyers, and also at the same time, people that are investors, people that are looking to expand their portfolio, and people that are looking to grow their portfolio in terms of buying multiple properties, and even for business owners as well, too, that struggle to get financing with the A banks that we talked about before.
Yeah, so A is like, first letter of the alphabet. That's the best one typically in terms of pricing.
Yeah.
So you have to have the best credit score. All your ratios need to be aligned. Everything needs to be AAA, the best.
Yeah. They have more strict guidelines, things like that. Yeah,
stricter guidelines. That's why they give you the better pricing. They may want to, at this point, name your firstborn child, draw your blood, all that stuff. That's A banks, okay? We all know them. Typically the big six, some credit unions, and you'll have some B lenders, which we're going to get into, that have what's called an A division. Yep. So if you're a B client, you want to move up to become an A client, and there's some reasons why you were a B client. Like, for example, you had some debt that you needed to pay off. Unfortunately, it brought down your credit score below what the A banks will accept in order to qualify you, but your income and everything else was great. You might have had to go to a B lender for 1 year till you paid off your debt, and then once your credit score went back up, you're able to now transition to the A side. So B lenders are just more flexible. I've been a B lender client for my entire career, investing in real estate, also as a realtor. Then I was able to go to A banks. And then once the A banks, I reached my limit with them, I have a couple mortgages with a B lender.
Yep.
So there's nothing wrong with that. They're there for a reason. And a lot of Canadians use them, and there's no reason why you should not be using them, especially as an investor, because you do need 20% as a down payment to get to B lender.
Yep.
But especially as an investor, because it's easy to qualify, easier than to qualify with an A bank, but also 100% of your interest is a write-off. I've said this so many times.
Yep.
100% of your interest is a tax write-off. You as a real estate investor, you're not investing in real estate properly if you're not understanding what leverage is, if you're not understanding what write-offs are, if you're not understanding how you write off your interest on your mortgage, if you're not understanding what cash flow is, what somebody paying down your debt is, and all this kind of stuff, equity and all that, you're not a real estate investor if you don't understand that. If you're not investing in real estate today because you're not aware of these B mortgages, or you are, and you say, well, I don't want to pay the highest rate. Well, I don't think you should be a real estate investor. because you don't understand that you could write off your interest at no matter what rate it is if you're investing in real estate.
Preach, man. You're preaching
sorry,
right now.
I'm just going off the topic.
I love it.
And then there's C lenders or what we call private lenders.
Yeah.
These could be institutions that typically will lend only based off of the equity in your home.
Yep.
So people who don't qualify with an A lender, don't qualify with a B lender, or flippers, you're interested in flipping real estate and you don't want to go through the process of qualifying for a mortgage because you're only going to be in this project for about 6 months from the time you buy it, renovate it, flip it. Then you want some quick access to financing, you'll go to a private lender because they'll typically lend money on the equity of your home. So let's say you buy a property for $1 million and you're willing to put 25 or 30% down, you'll pretty much get qualified without them looking at anything else.
Definitely. Like, picture it this way. The lower you go in the alphabet from A to C, the less requirements that are needed in order for you to qualify for a mortgage. So A, they're very strict. C, not very strict at all.
And it's an inverse relationship. So A is very strict, inverse between qualifying and pricing.
Yep.
So if it's very strict, like the A banks, they'll give you better pricing because you met all those criteria, all that qualification criteria, you met it. If it's less strict, then the pricing is higher because why? Well, the lender is not knowing everything there needs to know about you. Like the private lender is not going into your credit. It's not looking at your employment. It's not looking at some of the things that the A banks look at. So as a result, there's more risk to them. So as a result, they require higher down payment, but also they make you pay a higher interest rate and lender fees.
Yeah.
Now, again, if you're in it for short term, that's why flippers love private lenders because they're in and out very quickly. And at the same time, you write off all your interest and you write off your lender fees. So it's all a matter of the deal and your situation.
And I kind of just want to circle back real quick at the B lenders, just because there's a lot of more detail I want to go through with them. So let's list some pros and cons and go through, some pros first and then go through some cons. And then that way, for anybody listening to this or watching this, you could kind of evaluate for yourself, like, hey, did I fall into this category of people that can, use this and benefit from this, right? And the benefits or the pros outweigh the cons for me, right?
Yeah. So before you jump into B, I think A is very easy. The pro is that you get the best pricing and you're with a AAA bank or lender. And the cons are that there's very strict criteria that you need to go through in order to qualify for the mortgage.
Exactly.
Now, also for first-time home buyers, if you want to use the 5% down payment for properties up to $500,000 purchase price, or 10% down payment between properties that are between $500,000 to $1 million purchase price, to be more specific, $999,999, then you'd have to go to an A bank.
Exactly.
The reason being is the B lenders require 20% down minimum.
Yeah.
It's not important why. The insurance guidelines, it's not important why. You don't need to know. Just know that it's minimum 20% to go to a B lender.
Yeah, those are the rules.
So let's jump into the pros and cons of a B lender.
Let's do it because, like I said, a lot of people that we've helped extremely benefit from B lenders and their mortgage options that are available to them and through us, through brokers. And just to make that clear too, you can never just walk into, let's say, a B lender's building and say, hey, I want to get a mortgage with you, the B lender. The B lenders are actually only broker based. So they don't have the brick and mortar on every other corner like the A banks do. They have a head office and you're only able to access them through mortgage brokers such as ourselves. So just want to put that out there for a lot of people that don't know kind of how it works.
You could definitely walk into the building. You could definitely ask to get a mortgage.
Yeah.
And they'll say you need a broker. So there's nothing wrong with that. It's just they have really nice buildings in downtown Toronto, in this case, their head offices. And that's their model. They want to get to Canadians through mortgage brokers. And that's fine. That's their model. We access the big banks as well. So when I bought a lot of you've heard, my story, you're my brother, but a lot of you have heard my story. I bought my first condo when I was 19 years of age. It was pre-construction real estate. Fast forward at the age of 23, the condo was built. It was ready. And I was ready to get a mortgage. I did not qualify with an A lender. And I was just getting into real estate. I was in year 4. My income wasn't, that great. I was just starting out. I'm running a business, right? So banks look at business income very differently than salaried income. Mm-hmm. And so the B lenders is who I turned to. And at the time, I think my mortgage was 4.74%. And I locked it in for 1 year. I refinanced the condo a year later with another B lender for a rate of 4.5. It went down a little bit, and I paid off my school tuition, and I was able to do that. So B lenders, there should be no stigma, guys. It's whatever you qualify for.
Exactly.
You know, a lot of you guys are busy like, how do I get A rates? How do I do this or do that? Or how do I scam the bank or scam lenders or do this fraudulently or whatever? And it's like, no, we don't do that here, number one. But number two, you don't need to do that. There are lenders out there that will provide for people who have poor credit, not the strongest income. And why wouldn't you want your investments to be blessed? Why would you want to be doing something that's wrong? And what goes around comes around. You know, you can't live life both ways, trying to make it and then trying to take advantage or lie or do something on an application. You can't do that.
And honestly, just on that point, since we're talking about it right now real quick, like we could literally write a short novel about how many times people have come to us when they weren't our clients. They've come to us after this experience and they said, hey, you know, this is what happened to me. I went to this guy. This guy said he was going to be able to get me a mortgage. You know, I just had to pay him a little something. And he said he was good for it. He was going to do it. And this guy came to me, you know, the day before the closing date and said, oh, well, sorry, I actually can't get the mortgage for you. Yeah. You have to go get a private mortgage.
I have a funny story about this.
And real quick, before you get into that, and they've actually said to us, like, the guy charged me like tens of thousands of dollars and I had to bring a lot of money to him so that I can get the private mortgage cash. Yeah. So obviously, like, really illegal shit. Like, you're not, like, that's very illegal.
CBC covered this recently and they exposed a bunch of the realtors and the mortgage agents and stuff that were doing that. But at the end of the day, guys, you know, when there's smoke, there's fire. So you're putting yourself in that. A lot of those people, I can honestly say, put themselves in that position.
For sure. 100%.
As even the most innocent one, the innocent person that said, this, you know, this realtor was from the same country where we're from, and they told us this and we believed them. We're new to Canada, etc. Yeah, okay, fine. It's obviously sad when it happens, but you need to get a second and third and fourth opinion, guys. Come on, like it is what it is. So, I have a funny story about that. Early in my years in my real estate career, I got a phone call from somebody that we know. You know him too. He's like, hey Matt, you know, I know these people. They just came from Syria. And they bought a house. They didn't use you, but they bought a house. Today's their closing date, and their real estate agent doesn't want to release the keys. I said, well, what does their real estate agent have to do with anything? Like, that it's supposed to be the lawyer who releases the keys and stuff. And he said, well, I don't know, but this guy, you know, he's not releasing the keys. He's asking them to bring like $5,000 to his office. And I told him, I said, look, buddy, I don't want to get involved. Number one, they didn't work with me. And number two, I don't know what the transaction details are. I don't know what happened. So it doesn't involve me. I'm not a lawyer either. So why don't you just have their lawyer deal with it? He's like, the problem is they use the realtor. They use the lawyer that the realtor recommended. And they're all in on it. Yeah. And I'm like, he's like, you know, he starts painting the picture of the story, young family, and then also their mother and whatever. And, you know, they're like kind of from where we're from. So I kind of felt for them. So anyway, I connected with the guy. We end up, he's saying his realtor is telling him he has to come to the office with the money. Here's the text messages, all that stuff. And I said, okay, tell him you're going to the office. I'm like, we'll go to the office.
Well, you didn't tell him to tell the guy that you're coming, right?
No, of course not.
Yeah.
So anyway, we go to the office. So what they do is sometimes they close the deal, or usually it happens before the closing, where they'll say, the only way for you to get this mortgage, that's already been arranged, but a lot of people don't know the behind the scenes. People don't know the behind the scenes, They'll say, you got to bring us $5,000 cash or $10,000 cash. And we've had a lot of stories where people come to us saying that they experienced that, and it is what it is. It's their fault. Shouldn't have happened, but it's their fault.
Yep.
And so anyway, we pull up to this guy's office. It's one of the big brands that you would recognize easily. It rhymes with Carfax. And so anyway, not every office is owned individually and operated individually, but nonetheless, I never told this guy like I'm a realtor or whatever. I just sat him down and I said, look, I know what you're doing here, and you're gonna have a problem with the Real Estate Council of Ontario if you don't give, the couple was in the room with me, if you don't give her keys and you shake her hand, congratulate them, we walk out of here, you're gonna have a big problem. And again, I told the consumers to report them and stuff afterwards because I don't know the situation. I just know what they told me, right?
Yeah.
I don't know the situation, and I don't think they did. But nonetheless, the guy slid over the key, looked at me, looked at them, gave him the keys, and we got up and we left. And I was like,
what was
"You're
that
a
guy?
Piece of shit."
Yeah. What was that guy
You're a
thinking?
piece of
That
shit.
guy was probably like, "Who the hell
Sorry,
is this
guys,
guy?"
I don't like to use bad language. You guys, those who know me, I don't like to use bad language. But that guy was a piece of trash.
That guy was probably like, "Who is this guy? Is this guy like a cop or something like that?" And he was probably so sketched out because
No, he thought I was probably a lawyer. I was in my suit, whatever. Thought I was my lawyer, but it doesn't matter who he thinks I am.
Yeah.
That shit shouldn't happen.
No, of course
shouldn't
not.
slide. And you know, then I went to. They invited me to the house, so I went to the house afterwards, and you see the guy's old mother, reminds me of our grandma and stuff like that. And it's like, bro, they were sitting outside with a moving truck. They don't have the keys to their house.
Yeah, some people just don't have a heart, man. It's crazy.
Sketch. I know. But nonetheless, you have these lenders that are available to you. Back to the main point.
Yeah.
That you don't have to put yourself in those bad positions. And if you can't afford going to a B lender and paying the higher rates and doing all that, then you shouldn't be buying what you're buying. That's how I always look at it.
Yeah.
That's how I always view it. If you want to go the route of, I'm going to buy the real estate and then I'm going to go somewhere else and, you know, do the mortgage and whatever and come up with these fraudulent documents and all that stuff, like you're already starting on the wrong foot. Yeah. You're already starting on the wrong foot. We work in this industry and we don't even do that like for ourselves. Like, guys, just you have to live that life of as best as you can, being fair, being honest, transparent, and you know, good to others. And what you're doing, mortgage fraud is fraud. Not only could you be fined and go to jail, the lender will find out. They can call your mortgage immediately, and you have to get a new mortgage within like 30 days or something.
They'll blacklist you right away too.
They blacklist you with that bank that you committed mortgage fraud. So it's not cool at all. And you guys know we've from our podcast, you've heard us talk about things that you would consider religious, but it's not religion, it's our faith. You can't live a life like that. You can't do that with your investments. Otherwise, your investments will be corrupted. You'll see that investment won't work out. Something will happen.
More problems will
Other
come
stuff
up,
will happen in your life. No matter what people say, no, that's a bunch of baloney or foolish talk. And no, what goes around comes around.
I think so too.
And that's going to happen.
Yeah. Let's get back into the pros and the cons for the B lender specifically.
Yeah.
So one of the pros that a lot of people don't know about is the B lenders are actually able to, this is for the investors, by the way. So if you're an investor looking to invest and you bought one rental property, you want to buy another one. A lot of people don't know this, but the B lenders are actually able to use a lot more of the rental income than the A banks allow you to. So this is huge for your application because let's say, for example, you're collecting $2,500 a month in rent. Well, A lenders typically use only half of that amount, whereas B lenders are able to use sometimes the full amount, $2,500, or they'd use about maybe 85% of it, right? Which is significantly more than what the A lenders do. And as a result, there's going to be more income on your application. So that's going to help you qualify for a higher mortgage for the next investment, right?
Yeah.
So that right there is another pro. Another pro that I can think of right off the top of my head is the increased amortization. So for those of you guys that don't know, the amortization is simply how long it takes for you to pay the mortgage off. And these B lenders actually can go and give you a higher amortization than any A lender can. Some B lenders are actually giving people 40-year amortizations. And what does this mean for you? This means that the monthly payment will be lower. As a result, it makes it more affordable for you cash flow wise. Yeah. And you can get into a property that is more expensive.
Yeah.
Right.
It's also easier to qualify for the mortgage.
Yeah.
And some B lenders, we've done this for our clients. Some B lenders, let's say you buy an investment property that, you know, with a private lender, let's just say you close the deal with a private lender and then you renovate it. And instead of flipping it, you want to keep it. You want to refinance it. You want to put a tenant in there, the whole BRRRR strategy.
Yeah.
Well, some A lenders won't give you the equity on that deal because it's coming from a private, you just closed it. B lenders will be more flexible on that. And another example is if you close a pre-construction property, you bought something 2 years ago, 3 years ago, 4 years ago, it's gone up in value. Now you're ready to close it. On closing, some B lenders will give you a portion of your equity.
Yep.
So you don't even have to do a refinance. You close the deal, getting some equity out of it. That's huge.
It's huge because it also helps pay for a lot of the closing costs that come with pre-construction property, right?
Yeah, exactly. So it'll help you close the deal. It'll take some of the equity out, take your money out of the deal. So now you're in the infinite returns category. And again, if you're an investor, someone else is paying for it. Someone else is paying for it, period. And that's something you should take advantage of. I would think that another pro to a B lender is that sometimes if you're self-employed or you start a business, the bank requires 2 years of notice of assessments, 2 years of average of income. B lenders are a little bit more flexible. They'll look at your bank statements. They'll look at a year of operations, see how you did. You don't have to wait the 2 year minimum that A lenders require.
Yeah, they just want to make sure you have a legitimate business though. Like a lot of people think when they hear that, oh, well, you know, I do this on the side and, you know, I put the money in the couch and, you know, can I use that income? No, you can't do that. It has to be a legitimate business.
Yeah.
And where this really helps you is if, for example, you have a lot of expenses in your business and your net profit or your net income is lower, even though you do well for yourself, your net income is lower, you write off a lot of things so that you pay less taxes. The B lenders are more flexible in calculating your expenses, and as a result, the bottom line, the net income that you're able to show the B lenders is much, much higher than any A lender will accept. Yeah. So that right there is like literally night and day.
That's how I was able to close all my properties at the beginning before I could go to A lenders, because they would look at my gross income minus some expenses, and they would base that gross income off of bank deposits. So for real estate, it's harder you can't do stuff with your income. Like your income is your income. But for business owners who get cash, for example, and then they deposit in the bank, I'm not talking about what you do with taxes. That's your own responsibility between you and your accountant. Qualifying for a mortgage specifically, if you're making some cash deposits, you've got some invoices, you could show for it. Like you can calculate an income that's much higher on your bank statements than it would show up as on your, let's say, notice of assessment or something like that, right?
Sure.
You know how B lenders structure their deals.
It's perfect for subcontractors, people in construction. Like we've helped a lot of clients that are in that field. Just because a lot of it is cash, right?
And the B lenders are the ones that help you structure the deal. They're the ones that tell you do it this way or do it that way. And they're able to do that. You're putting minimum 20% down, and they're allowed to do that. They're able to do that. It's basically their money. So it's good for business owners. You want to take advantage of it. And then one of the frequently asked questions I get is, well, how do I get a second mortgage? It was so hard for me to qualify. And what Danny, for the first one, and what Danny said was perfect. You know how you said that the rental income? Big banks and other big lenders, the A lenders, will maximum take only 50% of rental income. Even though you're renting it out for $2,000 a month, they'll say you're really renting it out for $1,000. That's their policy. It's stricter. B lenders will go up to 75%, will go up to 100% in many cases of your rental income. So for properties that are cash flowing positive, if they take 100% of the income, there will be a surplus. And it makes it look like basically that you never got that mortgage in the first place.
It offsets it.
It offsets it completely in those property types where the cash flow is positive. So that means all your expenses are paid, including your property tax and mortgage and heating and all that stuff. So it's actually easy to get a mortgage for the second property with a B lender.
It helps you actually. It helps make it even easier too, because at that point now you have a mortgage under your belt. It helps increase your credit, right? The bank sees, okay, these guys already have a mortgage. We're going to help them get another mortgage. They have that experience. They have that responsibility. They haven't missed any payments on their mortgage. So it's only really, really good from there. Huge keys right now for B lenders. People, again, do not understand what a B lender is. If you guys are listening to this right now, you're getting some really awesome insight to how investors really grow their portfolio. And
B lenders, some of them are banks as well. They have their banking license, just like the big banks you recognize. So don't look at it from that standpoint. Don't be afraid of what people have gone through. You know how reviews are. Our episode with Jeff Schwartz, the liquidator, he said, you go to reviews, there's good, there's bad ones, and then you go experience it for yourself, and it could be either or.
Exactly.
So you don't know for sure, but take our word for it as the experts in that field. You could take our word on this, that a B lender could very well be a lender that you want to use and access and will benefit you. The only drawbacks with B lenders, in my opinion, again, are the higher rates. And again, the higher down payment requirements. If you're going in with the mentality of like, I'm a first time home buyer, but also the lender fees. So they do charge a 1% lender fee, and you're going through a broker. We're putting in work. We're probably going to charge you another 1%. So those fees, as an investor, you write all that stuff off. As an investor, 100% of it is a write-off, but you have to pay for it in some cases upfront. And those are the only drawbacks I would say. Everything else is a write-off.
I agree.
As a first-time home buyer, it might be a bitter pill to swallow, to have to pay for those things. But if that's what you're doing to get into the market, that's what it takes.
Yeah. Otherwise, you can still try to save money, but we all know how that works when it comes to saving for your down payment, as opposed to while at the same time fighting inflation. It's really hard to do that, right? So if you could get in with a B lender, do what a lot of our clients do, get in on the B side, and then after a couple of years, when you're able to qualify for it, we switch you over and do what's called the refinance, which is pay off the B lender and get you a new mortgage with an A bank. Where the rates are lower and there's no fees. So
there's different strategies. Honestly, we just renewed our mortgage on our house, and I was with a B lender for the house, and the rates were better, in my opinion, than some of the big banks were. And I had zero application fees and zero application process. Like I don't have to go through anything. I don't have to qualify, submit new documents, see if I qualify, all that. Sign one paper, renewed it with the B lender, renewed it for 3 years. And it was easy. It was done. So
and now you don't have to think about it for 3 years.
Now I don't have to think about it. So they're lenders like any other lender, and they just have those programs available to you at your disposal. And then private lenders. Obviously, private lenders, major pro, so
huge.
Easy to qualify. They'll give you equity, no problem. Only downsides of private lenders, again, higher rates, higher fees.
We've helped so many clients where they have a lot of, let's say, credit card debt, and guys, they're racking up like $50,000, $60,000, $100,000 in credit card debt
at 22%,
at literally like 22 to 25% interest, which is ridiculous. And we're actually able to go in and help them with what's called a private second mortgage, where the rate, let's say at that time, was about 10%. Well, when you're comparing 10% to 25%, that's a no-brainer. While at the same time cleaning up all the credit, right?
Boosting your credit.
And boosting the score, because once you pay off all the debt and all the balances you owe on the credit cards, your credit score is going to go through the roof. Right? So there's a couple benefits there, and private lenders are able to help with that.
Absolutely.
Even though they charge a higher rate, like I said, 10%, let's say at that time, or 12, 14% now, still better than 25%, right? So regardless of the fees and those kind of things that you're adding to it, you'll still end up coming out ahead and saving money. But I found it's more of a issue with the spending habits of the person, right? Where they're racking up so much credit card debt and things like that. What we often find is the credit card balances are just going to go up higher again. So you can do that. You can do a private second mortgage and, clean up all the balances on your loans. But again, you have to ask yourself, why do I have this much debt in the first place, right? Go to the root cause, because doing all this kind of stuff, we've seen people do it over and over again. Eventually, you'll just run out of equity, right?
Yeah, absolutely. But also keep in mind, like I have a friend, I've been telling him, they keep complaining about the debt that they're in, but meanwhile they have the equity in their home and they're not using it. So the money's dead money. It's in your walls. It's dead. But meanwhile they have 100, 200K in debt. That's unsecured debt, expensive loans. And here's the thing that most people don't understand, and even this guy, the way the debt is compounded on a mortgage versus on a private mortgage versus on your credit cards versus on your loans and lines of credit is very different. The way it's compounded, it's called compound interest on your Visas, on your MasterCards, on these things. It's called compound interest. Whereas on the mortgage, on the private side, it's simple interest. Meaning, if you're borrowing $100,000 at 10%, you're paying $10,000 in interest for the year. That's it. So you take that $10,000 divided by 12. That's your interest that you're making every single month. That's your interest payment. It's interest only. So you don't have to pay for the principal off. You pay that at the end of the term. So if you have credit card debt and unsecured loans and things like that, debt that you're paying 9%, 7%, 15, 20, and they're compounded. That's why North America is so indebted. Because they're paying what compound interest very simply is interest on top of interest. So now you're paying interest not only on what you owe, but also on the interest of what you owe.
Exactly.
And it compounds, it builds on top of each other. And that's why there's this perpetual state of just indebtedness. You're indebted and people can't get out of it in North America because their salary is the same. It doesn't change. Or their hourly wage is the same. It doesn't change. So sometimes private equity that's from equity in your home is a simple way to wipe that all out. You'll still have access to it, but you wipe it all out, your credit score rebuilds, and then hopefully you could transition from the private lender to a B lender or an A lender and consolidate everything.
Yeah, it's actually crazy how a lot of people like don't know about this, and you know, we're not taught this in school, right? We don't learn about mortgages and these kind of things, and that's why it's really important to talk to the experts, people that have actually helped people get out of debt, help people, you know, use and leverage their real estate to pay off all their debts and to actually put them in a better position to refinance, go to a B lender, and then eventually to an A lender. So we've done that for so many people, man. It actually works. It's not something that's fake or we're just talking ish about. It's real stuff, and we've helped real people about it. So if anyone's watching or listening to this, just let us know if you have any questions about your situation. Everyone's situation's unique, and there usually is, I want to say like 9.9 times out of 10, there is a solution for you.
Yeah, 100%. There's always a solution. Consult with us and we'll get into it with you, but every situation is different, and you have A lenders, B lenders, private lenders at your disposal. Don't listen to the naysayers. Don't listen to people who don't invest in real estate, who bought one property, it went wrong, they bought it by themselves, didn't hire an agent, went to a builder directly, tried to get fraudulent mortgage paperwork, it didn't work out. Don't listen to those people. Listen to the experts. You want to build a portfolio of 27 properties, 30 properties, 100 properties, 5, 10, 15, whatever it is. I'll show you how to do it.
That's it, man.
That's it. Thanks, guys. Appreciate you listening. And we just want to close out the show. Until next time, do your duties, like and subscribe and follow and leave us a comment. Let us know if there's any topics that interest you that you want us to talk about, and we will.
Yeah.
And until next time, you guys.
We're out.
We're out.